What are some common mistakes that you see entrepreneurs make?
Spreading yourself sometimes too thin. I think that's a big one, especially for people who are like wired as entrepreneurs. I've seen this happen a lot, like where you just, you're constantly following the shiny objects, and you've got to not do that. You have to focus in on what it is that you want and try to hit that as hard as you can.
Today's guest is a surgeon turned serial entrepreneur and real estate mogul, managing over $1 billion in assets. As a passionate financial educator and podcaster, he's dedicated to unlocking the secrets of alternative assets for high net worth individuals. Welcome to the show, Dr. Buck Joffrey.
Thank you.
As we dive into your story, I have to ask though, what inspired you to transition from a surgeon to becoming a serial entrepreneur? And were there any pivotal moments that influenced your decision?
Yeah, I think part of it is, I became a surgeon because when you are and people in your audience will, resonate with this, but when you're a good student, when you're getting good grades and you go to, good college and all that, you're sort of on the conveyor belt, of education. There are certain things that you realize or you're told that are kind of your options, right? I don't know if you're told that, it's just indoctrinated in the way we are. We're built as a society that creates professionals for jobs. And so I just went down that path and decided in college that, well, gosh, do you want to be a doctor? Do you want to be a lawyer? Do you want to go to business? Well, I just decided I'm going to be a doctor, and I did like biochemistry and molecular biology and all these kinds of things. So I went that way. And then the next thing you know, I went that way in college. And what can you do with that? You either get a PhD, you get an MD, So you get these forks in the road that are pretty typical for high achieving students. And I ended up in medical school. And from there, again, it was like, okay, what do you want as a specialty? And then I ended up in neurosurgery and that kind of thing. So what happened for me, though, is at the end of training, I got married. I'm no longer married, but I got married in the week after training and went to Mexico. And on the way back, I just, was looking for something to read on the plane, and there was a random book called the Cashflow Quadrant from Robert Kiyosaki. And I picked that up. I didn't know who Robert Kiyosaki was. I had no idea what any of this was, nor was I interested in business. But I read it, and it was really sort of eye-opening for me, right? It was awakening, where I just realized, oh my gosh, there's this entire world that I hadn't really thought about, which is kind of weird because my dad is a real estate guy too. But there's this world where I don't have to be employed, and that world looks more potentially profitable and more exciting. And so my first move was to just start my own thing in practice and brand it, that kind of thing. So I the entrepreneurial route just through medicine. And then when I started making money, I was bought some apartment buildings, small apartment buildings in Chicago, like 10 units, 8 units, and that kind of thing. And then started listening to guys like, Robert and Russ and the real estate guys, and about doing raising capital and going big. The next thing you know, there I am. I decided I'm going to do that because it made a lot of sense for what I was trying to do. And, ultimately, I will say this is the reason I think I'm also sort of genetically, this is my makeup, right? Like, it wasn't like an aha moment in a way. It was a discovery of who I actually am, rather than necessarily feeling like it was a huge pivot, but I was naturally inclined to be an entrepreneur. So
Accumulating assets that throw off cash flow and increase in value absolutely makes sense. And I see that natural progression. I appreciate you sharing that. You said it was really just a continuation of who you were, right? We all start down the path that's in front of us, and we make the best decisions we can along the way. Some work out, some don't. Some are great. Some fit us well, but there's always another path. And once you realize what's possible, that's when the opportunities really begin to open. So given your extensive experience managing over $1 billion in assets, what do you consider to be the most critical and maybe overlooked factors that have significantly influenced your success in real estate investing?
So, let me back up. And I think one of the big lessons that I learned early on when I went down this road of real estate syndication was that syndication is a business. When I first entered this space, I looked at guys that I, respected, like Kenny McElroy, and thought, look at what Ken's doing. And it just looked like, okay, he's the guy who knows all the building operations, and he's also the guy who raises the capital. And in Ken's case, that is true. But I think the major advantage that Ken had for years and years was he was always, the Kiyosaki real estate guy. So it certainly made it easier for him to raise capital early on. He's a great operator, period. Done. There's no question about that. But raising capital for him, I think a lot of the initial part of that was the association with Robert. And then, of course, it self-perpetuated because he did a great job. I don't think he would deny that. Now, for most of us, we don't have that, right? We don't have this, automatic way that people are going to start looking at us as a way to raise capital. So syndication, first and foremost, when you're talking about real estate syndication or any kind of syndication, there's two parts of it. There is the raising of capital. That is business. And there is real estate operations, completely different business. And when you partner appropriately, that's when you have success, right? I am not a real estate operator, right? I am a general partner on a lot of real estate, as we talked about. And I understand real estate, and I'm a good macro guy, right? But day to day, like I'm not walking these things and, figuring out where the value is and all that. I have people that I partner with who are really good at that kind of stuff. And so one of the things you got to figure out is who you are, and then partner with the other person who is your other half that can bring that other part with. Does that make sense? So to me, that's like a huge revelation for me when I started real estate syndication. I mean, you're not going to do both. You're going to be one or the other, and you're going to partner with the other.
It makes all the sense in the world. The real success I've had in life has been finding the right partners and people to, one, work with directly, but two, to guide and mentor you specifically, because not everyone can be all things. And more importantly, you don't have to be. Whoever you are as a person is more than enough. It's really finding the right people that augment your skill set and build and add to it so that 1 + 1 starts becoming 3. That makes all the sense in the world.
The key is the right partner. Like you can't partner with a friend, right? That doesn't make sense if that friend is exactly the same as you in terms of skill set. Just makes zero sense. So my partnerships have been with companies, right? That are, for example, they are doing, they're doing a good job maybe with their operations, and they've shown some success, and they need somebody to help them scale, right? So I'm the guy who comes in to help them scale if they've already got a track record, right? That's kind of what my role has evolved into. And so, again, there's plenty of, other models out there, and I've seen people do really well, but, I just think, like, at the end of the day, your partnership needs to have somebody who's good at raising capital, somebody who's good at being operations.
That mirrors my experience completely.
Right.
I appreciate you sharing that. Thank you. Okay, Buck, you just said that you're the capital guy. You're the person that's out there meeting the investors, aggregating the funds, working to get the deal done. How are you identifying emerging trends in the real estate market? As a real estate investor, what advice would you give to new investors looking to capitalize on trends?
Well, I mean, I think you have to be really You have to get pretty good at macroeconomics, and and trying to understand what's going on out there. And certainly in the last couple of years in real estate in particular, it has been a real challenge because I think a lot of things happened that not a lot of people predicted. Obviously,
Absolutely.
With specifically when you talk about COVID, and then COVID, believe it or not, people who bought in COVID, like when we bought in COVID, those were great successes. But then post COVID, the interest rates going up as quickly as they did, and value add a lot of times, you're doing floating rates, that kind of things.
The return to normalcy was completely abnormal from everything that we were just living through.
Yeah. So I think you do the best you can with the macro part, and you learn lessons along the way. I think you're not always gonna bat 1,000. You're just not going to. And we used to say in surgery, the surgeons used to say, the old surgeons that trained me, said, if you ever run into somebody who said they've not had any complications, well, they have not operated enough, right? So eventually you're going to have some complications. And so the key is, what do you learn from them? How do you handle them? And then move on. And, if you're in this business for the long run, you have to continuously be, you have to recalibrate constantly.
Accepting the hard truths, whatever they are, is
and learning
really the
from
moment
them.
you can begin.
Yeah.
So true. Yeah. I love that. And Buck, I love hearing that you're a macro guy, because everything that you're saying about finding the right partnership and allocating dividing the workload into the people that are able to serve it best completely mirrors my macroeconomics class back in college, where, divide the workforce, and some people are going to be making butter and some people are going to be making bullets. And it's really about the maximum efficiency of the team as a whole. And everything you're saying mirrors that. That's incredible.
Yeah, it's just, that's the big thing. And in terms of, and then macro has the other part of it, which is just like sort of anticipating, what are good times, what are bad times, what are big trends in the economy, how is that going to affect real estate, right? So, and, just to be clear, like, I've done things outside of real estate as well. So, like, again, I'm an aggregator, and I'm basically putting together opportunities. And so they may not always be in real estate,
So let's focus on your specific skill set and where your heart really is focused on right now. What strategies do you recommend for securing funding and attracting investment?
Well, okay. So I think the big picture is that Russell Gray, again, Russell from, he was with Real Estate Guys for a while, and he's not one of the real estate guys anymore. He retired. But he used to always say, to build your brand first, right? Like, you build your brand, and ultimately that's what is going to help you to raise capital. So I think that in order for people to invest with you, they have to trust you. They have to like you, the no like trust thing. And they have to think you're competent. You have to say things that resonate with them. So my focus on this has always been education, right? I don't sell. I never sell. All I tell people is what I know, what I've learned, try to make things clear. And if I'm behind an opportunity, meaning that I'm actually supporting it, if I can't teach it well enough so that people understand it and want to be part of it, then I shouldn't be part of that offering. Right.
So that's kind of what you're doing.
Yeah, exactly. That's all I'm doing. And really it comes down to, if you believe in it and you can explain it, right? If you can't explain how something works, or why something is attractive, then you probably shouldn't be involved with it, right? So all I do is, first of all, it's really a two-step process, really, because building the brand has nothing to do with raising capital in my case. Because if you listen to Wealth Formula podcast, I don't talk about raising capital at all. I mean, I talk to economists, I talk to, authors, thought leaders on what's going on in the economy today. It has nothing to do with raising capital. I think that when you talk about things that are interesting to you and show what your own strengths are, people will resonate with you or they won't. And if they resonate with you, people will invest with people who they like.
The education piece along the way is critical because until you have that, at a basic level, if you don't know how to work the shovel, you shouldn't be supervising the crew digging the ditch, right? And the education is what gives you the confidence to speak plainly, clearly, and properly to what you're doing, which is then builds the trust and aggregates yourself as the thought leader with that audience around you. It makes a lot of sense. Buck, how do you explain alternative assets? From a let's make this accessible and educational. What are alternative assets and why are they particularly beneficial for high net worth individuals?
Well, I mean, I think there's a couple different ways to explain this. Depends who you're talking to, right? I think if you're talking to most people, I think what you're really talking about is, investing in things that you can touch and feel and see. And that's why they're tangible versus just a bunch of numbers on the screen, right? So I think a lot of people resonate with that idea in general. Tangible assets also frequently have significant tax benefits with them, right? Because with real estate, for example, you have a lot of depreciation, all those kinds of things. I think when you're talking to somebody who is, probably a little bit more just sophisticated in terms of investing, I think you point out a few things, in my opinion. There is a potential for much higher return in alternative assets, and you're not trading in necessarily a whole lot more risk for that. So I do think that there is, and you see with high net worth investors now that more and more are seeking the quote unquote alternative assets because they know that, when we're doing real estate or value add real estate, our targets are going to be, not 5 or 6%, but closer to, a 20% IRR, right, over 5 years. That's probably closer to what we're in. And that's something that, we saw a ton of. Obviously, like, we're not in great times right now in the last couple of years, but we've seen a ton of it in the last couple of decades, right? And over time. So you talk about that. I think that's one of the things that are interesting. And then again, go back to the tax piece, because again, you can generally, with a high net worth investor, show them how, they have to do about half as well in real estate as they do in stocks, in stocks and bonds, because, a lot of the depreciation elements sort of take away the tax liabilities. So I think those are probably the two biggest things that I would focus in on.
I see it as essentially a risk analysis where the risk versus the reward. And at the end of the day, if you buy that 8-door down on Main Street, it's still going to be down on Main Street most likely 5 years from later. But you factor in what people are actually doing as far as returns and the cash flow they're producing, whether there's appreciation or not. Then you start adding in the tax benefits along the way. Well, it's a compelling argument. It makes a lot of sense to me.
Yeah, absolutely.
What advice would you give someone starting their entrepreneurial journey? And, maybe they're feeling overwhelmed by the inevitable challenges ahead. Maybe they're not. Maybe they don't know about them yet. But what's your starting out advice?
So are you talking about entrepreneur specifically as an aggregator or in general?
That's a good question. You want to focus it more on real estate?
Yeah. So I think specifically as it relates to real estate syndication, I think that, first of all, you have to figure out that, this is something that, that you really want to do. Like anything else, it will take a lot of effort. You can't, it's hard to do these things for the long term, sort of really part-time. So what you're talking about is sort of a full transition over a period of time. So I think if you're open to that, then consider it. Now the challenge is going to always be that first deal or that first or second deal, because you don't have the identity as of so that people are familiar with,
right,
as a real estate syndicator. And everybody started out somewhere, right? And so how do you get over that? And I do think that that's where making sure that if you don't have a lot of experience, that you partner with somebody with a lot of experience early on. And, part of that might be, listen, at first you may even work for somebody and try to learn the business.
Absolutely.
Try to figure out where you, in general with entrepreneurship, I think it's one of the biggest secrets out there is like, I have a bunch of friends who are entrepreneurs and really high net worth guys, and 99% of them did the same thing. They were working for somebody. And I'm not talking about real estate necessarily, right? They were working for somebody in some business, figured out how the business worked, left, and did the same thing. Right? And sure, they for a year or two or whatever, they were employees, but that's fine because basically they were just getting an education in this
you better believe it.
field. Right. So if I had to do it over again, in many ways, I think and if I didn't have sort of, my path that seemed to work out, I think that would be a very interesting way to approach it, right? Is just in general is to find, a business or people that you just want to work for, and don't worry about how much you're going to get paid, especially if you're a young person, doesn't have a lot of expenses and stuff like that. Spend this couple years as a student who's getting paid, but maybe not get paid much, but learn everything you can, make as many relationships as you can, and then make your move.
That'll pay off in folds.
Yeah.
How important do you see grit, determination, not giving up to your success?
Well, I think it's definitely a big part of it. I mean, I think you have to, consistency is really important. I mean, I think what I do, in general with, my investors pretty much come from my podcast, right? And so I have been podcasting. I haven't missed a week in 10 years, something like that. And so that you have to be consistent, right? And whatever it is that you do, you have to be consistent. And, you can call that grit, you can call that whatever, but I think you have to understand that these things don't happen overnight, right? And it may take a few years to get to the point where you want, but it's like the old Bill Gates saying about, people grossly underestimate, what can be done or they grossly, I guess, overestimate what they can do in a year, but grossly underestimate what they can do in 5 years. So I think that's the way you approach it, right? Like you come up with a plan, you start plugging away, and you keep doing it, thinking to yourself, this is how it's supposed to be done, so I'm going to keep doing it. And be patient.
What are some common mistakes that you see entrepreneurs make? And what are some ways that they could avoid those pitfalls?
Well, entrepreneurs in general, I think, yeah, I mean, there's a lot of different things. I think early on, I think, because I've done a few different kinds of businesses, right? It's not just aggregation. It's not just raising capital, but I think spreading yourself sometimes too thin and having too many things to do and not being able to focus is probably a big one,
Back
especially
to the focused effort you mentioned.
Yeah. I mean, I think that's a big one, especially for people who are like wired as entrepreneurs. I've seen this happen a lot, like where you just, you're constantly following the shiny objects, and you've got to not do that, right? You have to focus in on what it is that you want and try to hit that as hard as you can. On the other hand, there is also this element where once you have some success in a particular business, I think it's really important to actually invest outside of the business as well. That's probably counterintuitive because a lot of people talk about constantly investing in your business, but I am a big advocate for making sure that you don't have single point failure, right? I've always, like for myself, felt uncomfortable unless I had 3 different ways of making income.
Oh, that's good advice.
Yeah. And so, for me, like they're pretty diverse, right? I have my aggregation stuff. I'm in the insurance space too. And I'm also, well, not right this minute, but probably getting back into some medical related stuff again. So I think like trying to make sure that you're not a one, single point failure target is really, really important, because, that's where entrepreneurs sometimes get caught too, because they're so singularly focused that they have nothing outside of their business. And that's great. Sometimes these people end up having like, $20 million, $30 million businesses, and that's a great asset to have, maybe even bigger. But the problem with a single business is like within a year, you could have a business that's worth $50 million all of a sudden die, right? So I just think if you are right now an entrepreneur, think about that and start, for yourself, just creating a little bit of hedging. So
it's a great reason to get into real estate, folks. Mm-hmm. Let's talk about that. What are your future goals, both in business and in your personal life?
Yeah, I don't know. It's a good question. I think the issue with the issue with entrepreneurs who are wired like the way I am, because I am really wired as naturally as an entrepreneur, is that you're sort of attracted to the game, right? Like you want to see your ideas come to fruition. You want to see success happen. And the way entrepreneurs often don't do what they do for money. They see money as a way of keeping score of their own success.
They're driven by something.
Yeah. So I think for me too, like that's always been the case. But, now I'm also, now I'm 51. And so I am trying many ways to sort of be a little bit less frenetic, because there is, sometimes you get a pretty wild pendulum moves in terms of your wealth, in terms of, your cash flow and stuff like that when you're doing a lot of things. So I think for me, I'll continue to raise capital on opportunities that I think are worth it. I'm also very wary right now of the way the economy is. I'm not sure which way it's going, so that makes it a little bit more challenging in this environment. So I'll keep doing that. But I think for me, like I'm sort of in a phase right now where I'm looking at other opportunities that are not correlated directly with real estate, because in the last, 5 or 6 years, I've been 70 or 80% real estate, right? And so as real estate right now, as the opportunities are there's far less opportunities now than there were. And I think the appetite from investors is far less than it was 3 or 4 years ago. It's a good time to sort of, build in other directions. So that's kind of what I'm doing. It's not that I'm stopping, doing the syndication thing, but you also don't want to end up in a position where you feel like you have to syndicate. I think when there was a lot of froth in the economy, I think that probably a lot of groups, and I don't even think that it's conscious, but I think I think they continued to buy because that's what the business is, to buy real estate, right? And I think when you do that, when you're in that business, you have to be very careful, because there will come times when froth comes again, and you want to try to recognize when that froth happens and put on the brakes. And there was, I can tell you, very smart people who did not do that this time around. And so I think trying to be very cognizant of that, making yourself a little bit less dependent on having to do a deal, for sure, is really important.
Be mindful what opportunities are actually in front of you, not just pursue
try
your
to
goal,
be,
but actually
and try to be very critical about them. Even right now, it's funny to talk about this now in a way, because right now is the farthest thing from froth there is. Right now, no one wants, very, very few. There's very little appetite right now for real estate syndication out there compared to where it was. Right, it's the volume is way down right now. But what happened, and I guarantee you it'll happen, whether that's 2 years or 3 years from now, is that the economy will start booming. There'll be a lot more liquidity in the real estate markets. People start making money. People start realizing that they're not making money and they want to get into it, right? So the distance between a market that is kind of flailing like right now and full out froth it doesn't take very long, right? And, we're talking, in my opinion, 3-4 years, So
maybe that's the opportunity for those new real estate entrepreneurs, is to start setting themselves up with the education and the network around themselves and be that thought leader for their organization.
Yeah.
That they're
building. Because I started my podcast, I don't know, maybe I think I started doing a few and even in 2014 or something like that. And I didn't start raising capital for 3 years. I just, part of it is it hadn't occurred to me to raise capital,
Sure.
but also I needed to be the right time. And I didn't really necessarily feel like I had the right partners. So right now might be the time where you start, building your brand, getting a following. And these days it's so much different. And I certainly was one of the first to do this, where I use a podcast platform, in my syndication business. But now a lot of people are doing that. And I think it's also a great idea, because, if you can get a following and you get people to listen to you and they believe in you, then that's a good way to potentially get, to get investors. Now, because I'm terrible at asking for money. I'm not good when it comes to being like, hey, do you want to put so much money in this deal? It's a lot easier for me to just have a webinar teaching people about stuff and letting them decide if they want to put money in something. So
That's perfect. You don't have to give the hard sell. Just share what you're doing.
Yeah.
You keep mentioning timing and essentially letting the stars align to what you're doing. You talked about persistence and doing the same thing until the right opportunity comes or the right time happens. Let's discuss your investment philosophy here. Are there specific key principles that you're following, or do they change really depending on the property or the deal or even the economy?
I think with value add real estate in particular, generally the things are pretty much the same all the time. You look for metro areas. That for me, I don't like to be in tertiary markets. I don't like to, I like to be in the markets that are booming. So the Dallas, Fort Worth, Atlanta, Phoenix, those are the types of places. Some, maybe Charlotte, some of the Southeast. I don't like to be in markets where they're not driven by demographics and jobs. I mean, I think demographics, jobs, like population growth and jobs, it's as simple as that. That's where when you look at a market, that's where you need to be, right? And in terms of other things, I have been primarily in the space of sort of B class stuff. I mean, I'm not really in the A class stuff. And the reason for that is the value add business is really about value add. So if you're already A class, there's not a lot of room to go, right? With a lot of B minus class stuff, you can find things that, you have an owner that's owned something for a long time. It's not really just really collecting cash flow. You can, create value. And that's a big part of it too, is, any opportunity that we're going to look at with any partners is really coming down to value, opportunities to improve things, right? So if there's nothing, it's not a buy and hope strategy. It's a buy and, force equity. Right? Like you want to be able to create value. Now, the challenge in that is, can you, in this economy right now, you have to really think about that, right? Like you have to look at where rents are across the board, the comps and that kind of thing, and probably be a little bit less optimistic that you're going to go much past those comps in the short term. Because, I think you could, in the past, we were projecting 2 or 3% rent growth per year, but, we've had not a lot of rent growth in the last few years. So you have to be real careful. I mean, it's kind of like 3D chess at the end of the day, right? You've got multiple variables coming in at the same time, and you have to project the best way you can.
It sounds like you're coming back to the jobs and growth and
jobs and growth
people.
is a big one, and that's why I think macro is important. That's why macro is very, very important. And one of the things that makes me a little bit hesitant about what to do right now is, again, interest rates. I thought, and I think a lot of economists thought that rates were going to come down in 25. I mean, we were all talking about survive till 25. Yeah, that was the mantra in real estate, in the real estate world, but we're not seeing that. And I'm not so sure we're going to see that. I'm not so sure we're going to see that in 26 either. I don't know. It just seems like there's a lot of moving parts. We've got the issues with the tariffs, the whole issue with the 10-year treasury is very complex, and there's a lot there. And I think hopefully in the next 6 months, that plays itself out. But when you see the 10-year ticking to 5, I mean, that is a very, very...
Walk us through this.
In terms of the 10-year treasury?
Yeah.
Yeah. So, I think, value add real estate, again, most of the time what you're going to do most of the time is you don't use, you often use floating debt, right? You're not using fixed Fannie Freddie debt. And people often ask why. And that's a good question. Because when you use, agency debt like that, there's often huge prepayment penalties. So if your goal is to hold something for 3 to 5 years, and you end up, having fixed debt for 10 or whatever, it's gonna be a huge cut into your profits when you sell that property. So a lot of people don't do that. Now there are ways to manufacture sort of fixed debt. In those situations, what you would do is, one group I work with I think has done it very well, where you do fixed debt, but you buy 3 years of rate caps. And so effectively for 3 years, you've got a ceiling on your debt. I think it's a very, very smart move. Yeah, it's a very smart move. Now, the problem is if you're starting, when you're first buying in and you're already, the 10-year treasury ultimately determines, for the most part, is going to be very similar to what you're going to see with, with these short-term, with these floating, with floating debt. And what ends up happening is if you're starting out higher when you first buy, it's going to make it a lot harder to make those numbers work. But also, that debt is very expensive, right? Period. So what if it goes higher? I mean, that's what happened in the last couple of years. And it really, devastated a lot of large real estate companies, right? So that's why I'm talking about, if you're seeing, 10-year treasuries going as high as 5%, like that's pretty nerve-wracking, right? To see that. I think we'd like to see them closer to 4, So
because at 5, it's essentially projecting the future that we're coming into. Or
yeah, I think the
you're
market
gonna have
looks
to
at
operate with
5 as a very scary thing, Even okay, let's go. It's outside of, if we go outside of even if we go outside of real estate.
Okay.
If you have a 10-year treasury of 5%, which basically is you buy bonds that are 100% secured by the U.S. government at 5%. Large investors, why would they own equities at that point?
Why take any risk for a few points more?
Right. So it's a big problem for the economy. It's a big problem for real estate in general, because now you're, a lot of most debt that's out there is not at 5%, and so it is putting a huge strain on people's people's debt. So yeah, I think it is. I think it's a scary time, and I don't know exactly how this is going to play out. I just don't know if we can get these rates under control. And so that makes me a little weary right now about being very aggressive with buying. Now, if you find some opportunities, most of what my group is involved with is basically being at the, basically feeding on distress, right? There's not a ton out there because people are holding on for their dear lives, but once in a while you're finding things that people are just walking away from, and it's, you're getting, a huge discount on, 30% discount on, or something like that. That's about the only thing that I'm interested in right now. I'm not interested in going in at market at all. So,
and it sounds like you're mainly focused on large multifamily, maybe some commercial, but completely the normal single family home, those sort of thing doesn't really fit your model or the scale that you're operating in. Do you see that being a better opportunity for the normal, I'm just getting started with real estate, or what do you see there?
I don't know. I mean, I think, another thing that people can do right now is, I think, learn on smaller properties. Now, I do think that there's a difference between larger properties and smaller properties. Single family home is a completely different animal, right?
Yes.
I mean, once you get past 5 units, at least you're using, under 5 units, you're pretty much like, you don't even really use cap rates and all that stuff. You just kind of, how much is this house worth? Well, how much is it worth to you? Like that's kind of what you do. But whereas like, if you're getting to 5 units and above, then people start looking at it in terms of cap rates and actually doing the math. And so it might be worthwhile to, if people can put together a few partnerships, maybe they're not, aggregating, but a few partners putting together an opportunity by 5 unit plus type things, just to try to get a feel of things, try to get a sense of the real estate business. And of course, my first few apartment buildings that I bought on my own, some of my biggest profits, like by percentage, I mean, they were much smaller, but I mean,
sure.
500% returns in like 3-4 years. And, sometimes it's just a matter of being in the right place at the right time and that kind of thing. Right. But
absolutely.
So,
and at the smaller scale, essentially gives you that opportunity to be the boots on the ground in your area and to look for those particular deals. I mean, what the advice I'm giving our audience today is give all the profit away, focus on gaining the knowledge, focus on the experience, focus on ultimately getting that education that you're talking about, building your name, building that brand that you mentioned. And then from there, the opportunities will flow. The major economic differences and environment that they're operating in may be different at that time, but either way, they'll have the base education that they're going to need.
Right.
That makes a lot of sense. Hey, Buck, congratulations on 11 years of hosting the Wealth Formula podcast. We're fueling a very similar audience. So let me ask you, share some insights into the topics you cover on your show.
Some insights. Well, the topics on my show are the things that I'm thinking about a lot of the time, right? I mean, we certainly have some stuff on, my audience generally is high paid professionals. Because of my background as a surgeon, I tend to have a lot of medical people listening and stuff like that.
Sure.
So, the types of things we talk about are strategies, personal finance strategies, whether that's, insurance based or asset protection or estate planning, things like that relate to those people. But also, again, I do a lot of macro, and my macro is not just about real estate, right? I mean, we've been talking about buying and selling businesses too. Been talking about Bitcoin. I mean, so there really isn't any necessarily anything that I'm not too narrow. Like I try to make sure that the goal for me is that people in general who listen, are aware of what's happening that's important, that might be relevant to them as retail investors out there.
Gotcha. It sounds like you're really focusing on opportunities to efficiently deploy capital or waste.
I think that's true. And again, it's not always just about, hey, you should be investing in this. I think, for example, I did a number of shows on artificial intelligence, in part because, there's nothing I could possibly offer in artificial intelligence, but that doesn't mean I can't tell people what I learned about it, because I think it's an incredibly important thing for people to know about right now.
Absolutely.
And so, that's really what the show's about, is trying to educate people on what I think they should definitely know right now, whether or not it has anything to do with, the business part of Wealth Formula. So
let me continue on that education topic. You mentioned Robert Kiyosaki and the Cashflow Quadrant earlier. What books do you recommend for aspiring entrepreneurs looking for more information on real estate investing?
Well, gosh, I mean, if you're just starting out, you might as well start out with Ken McElroy's books, right? ABCs in Real Estate, and then there's the advanced ABC's advanced. I think it's still the same thing, the advanced ABCs in real estate. I think Ken's books are really good at just giving you all the terminology, right? Those are really useful. So that whenever somebody's talking about, cap rates and, all that kind of stuff, what they're talking about, you understand. He gives lots of examples in his books. I remember again, literally reading these in 2009.
Okay.
And feeling okay, now I know what people are talking about.
Yep.
Right?
The core education defining the real estate which you're playing within.
Yeah, I think that's right. I think it's for real estate, people starting out in real estate, I think, that's a good place to start. Obviously I think there's, the reason I like the Kiyosaki books is it's so simplistic in many ways. And, I met Robert a bunch of times and he's a very, very smart guy, very sophisticated, but his writing is really intended to just kind of simplify concepts that are very, very important for entrepreneurs to understand. So I think particularly the Cashflow Quadrant is a good one, because you start understanding about taxes. I think Tom Wheelwright's book on tax-free wealth is a really good one for people to read. Yeah. So there's a few.
Good answer. Just a quick reminder to our audience, Dr. Buck's website, podcasts, and social links are in the show notes. Make sure you follow and connect with him. Buck, I got one last question. I'd like to leave our audience with a interesting anecdote or story about yourself that they may not know, or that something they may find interesting. What would you like to share today?
Well, okay. Yeah. So, again, going back to the idea that sometimes you just have to jump in or get a job or whatever to learn. Once I read Ken's books, I decided I was going to go out and, try it out. So, the first property I bought was in the south side of Chicago, and all the numbers looked fantastic. Right. And I think I ended up buying this thing. It was like $300,000 or something like that, 300, maybe $400,000 or something. And the second I bought it, nothing worked like it was supposed to, right? All of a sudden, no one was paying rent, and and I had a property management problem. I had all sorts of stuff. So I ended up selling that. I think I bought it for like 400 and sold it for 300 or something like that. And it was a huge loss, whatever. But I learned so much from that mistake,
Yep.
just about due diligence and all the elements of, being screwed and lied to by a seller and how to potentially avoid those kinds of things. That I think I just go back to this is that, again, you have to jump in. I didn't stop doing real estate because of that.
Right.
And then, like I said, the next few buildings I ended up making like 500 and 600% in terms of my equity. And
Nice.
so, you're going to, again, you can't expect to only win in this game. You can't. It's unrealistic. Go in, get your feet wet right away. From the time that I started thinking about doing syndication to actually doing it probably was 2 years. And in hindsight, I feel like those were 2 very, very good years that I could have been in the business that I missed out.
Absolutely. Getting that real education.
Yeah.
Aim small, miss small, but most importantly, keep going.
So if you want to do it, just do it. Stop thinking about it. So,
Dr. Buck Joffrey, thank you so much for being on the show with us today.
you bet.
Thanks for watching. If you enjoyed this episode of Planet Wealth Fortunes of the Brave, check out our other videos for more insights and strategies to elevate your financial freedom. You can subscribe right here and hit that notification bell so you never miss an update. Join our community and take your financial future to the next level. I'll see you in the next video.